Hey everyone, and Happy New Year. Jeff Dorman, Chief Investment Officer of Arca, back again for another edition of That's Our Two Satoshis Live, where we talk about things happening in the crypto markets. And this year, we are going to be giving our 2026 predictions. Before I get started, as always, this is not investment advice. So let's start actually before we get into 2026. The book closed on 2025, obviously not the best year for crypto. What's interesting about what happened from a price action standpoint relative to what our expectations were in this year was that just about everything we predicted actually came right in 2025, except for price. Probably the only place where we really whiffed was talking about the intersection of AI and crypto. In the early part of 2025, we were certainly big on the idea of AI agents and other crypto launch pads that were going to basically be the medium for a lot of innovation in AI. Many of you know we've long been investors in the BitTensor ecosystem, actually, building subnets with AI. Also thought some of the AI agents and AI platforms were going to help people navigate through crypto. And also, as we've talked about multiple times, that there's this natural intersection in the sense that any AI agent can't really walk into a bank and get a bank account. They don't have a social security number. They can't open a brokerage account. So the only medium they'll be able to transact in eventually will be in crypto assets. So whiffed on that, but pretty much everything else we thought was going to happen in 25 did happen. We talked a lot about softer regulatory actions coming from the SEC and the CFTC and others. Talked about laws finally being passed in Congress and having a bipartisan Congress actually pro-crypto. Not to mention, this wasn't really a prediction, but we knew that the Trump administration was certainly going to be more pro-crypto. And also, more importantly, we talked about new tokens coming to market, right? It wasn't just going to be your crypto native, dot cryptos, similar to the dot coms, right? We weren't going to just see these protocols. We were going to start seeing regular companies, regular entities issuing tokens. Saw a little bit of that, starting with the Trump token, which obviously was flawed by design, but at least it was a new non-crypto entity that was issuing tokens. Obviously saw the Argentinian president do something similar and others. These didn't work, but it was still a prediction that we nailed in terms of the fact that we were going to see more of these tokens. Not to mention launch pads, everything from Pump Fund and Launchcoin that we're trying to get others to start to issue tokens. So, got that right. We are seeing more of that, and I think we'll see even more to come. And even more importantly, starting to see the real Wall Street tokenization, Wall Street kind of efforts coming into crypto. A long belief of ours has always been that a blockchain basically doesn't matter for anything other than asset transfer. And almost all of the assets to date on crypto rails are just made up quasi-equity like assets. But the majority of the world's assets are in dollars and bonds and equities and real estate. And then we were going to have to start seeing that stuff come on chain before you saw any sort of real growth in the blockchain world. And of course, we're now seeing that with things like the DTC and JP Morgan and BlackRock and Robinhood and all the other efforts around tokenization, not to mention equities coming on chain with perps like Hyperliquid. So anyway, long story short is we really did see a lot of growth and a lot of progress in crypto in 2025 for everything except for the price of these assets. So we'll give ourselves a B plus or B minus, I guess, in terms of predictions. I guess an F in terms of investing, in the sense that these things didn't go higher despite all the positive news. But where it stands in terms of where we're headed for 2026 and beyond, a lot of those things are still relevant in terms of where we think we're headed. We're still going to see more and more non-crypto assets moving on chains, equities and debt and real estate. We're still going to see new issuers. Hopefully, eventually, my dream comes true that companies will have tokens in their cap structure like Netflix and Disney. You'll start to see New York City and Miami and San Francisco issue coins. You'll start to see universities issuing coins. Like, I really think that we're going to see more of that. But in terms of official predictions, I'll give you 5 for 2026. So number one, I think the industry are going to have to start putting in a lot of effort to see better long-term stakeholder alignment. Some of this is due to the success of hype with 99% buybacks, but really we've seen the other side of the equation as well. More recently with Aave, the DAO for Aave versus the equity of Aave Labs, and how they're fighting over who owns the assets and where revenue accrues to. We've seen some M&A, notably both Circle and Coinbase made acquisitions where they didn't take care of token holders of the acquiring entity. The flip side is you saw Pump.Fun actually did make an acquisition and then paid out token holders. But long story short is this is something that we've always believed was a big a positive for crypto, was that the whole point of tokens was that it sort of fully aligns your stakeholders meaning your founders, your employees, your investors, your customers. All of these can be united by a token if done correctly, right? Binance is probably the king of that. How Binance got early investors, founders, employees, and customers all to rally around the BNB coin. Hyperliquid has done something similar and has also introduced 99% buybacks of their revenue to even further align the value of the hype token with the growth of Hyperliquid. But I think this is where we're going to see almost everything go this route in 2026. You could say this was also a 2024 and 2025 prediction of ours because we've been talking about this for years as well. But we do think this is on the cusp of being the most important factor in 2026. You're just not going to be able to see tokens being issued anymore that have no value drivers, right? It has to have some sort of financial driver or utility driver beyond just sort of social trading value. And you're really going to see tokens and token issuers put a lot of thought into this alignment in 2026 and beyond. The team at Arca has done a lot of work with tokenomics with a lot of different companies in that regard. And we think more and more are going to find that to be not just an interesting way to make their token go up, but quite frankly, the only way to avoid their token going straight down. Because we've just seen too many of these things crash and burn that just have absolutely no value drivers whatsoever. Prediction number two, I think in the next year, you're also sort of in line with number one, but I think you're going to start to see the emergence of some hybrid valuation frameworks that really integrate on-chain analytics with traditional financial metrics. Tokens will start to be assessed more similarly to equity and fixed income instruments. I've talked about this a lot as well. You go back 100 years, nobody knew how to value stocks until Graham and Dodd and eventually Warren Buffett kind of introduced value investing. And now everybody adopts the same framework for valuing equities, right? There was a time period for hundreds of years where stocks traded just purely based on charts and technicals, and nobody knew anything about market cap and about PE ratios and things like that. But eventually that became the standard. And same thing in the fixed income world, right? Bonds have existed forever, but nobody really understood duration and covenants and call structures and different ways that we now look at the fixed income world. None of that existed prior to Frank Fabozzi in the 1960s introducing his fixed income handbook, and now every credit investor looks at fixed income the same way. I think that's where we're headed with tokens now as well. It's not going to be as standardized because, truthfully, there is no one-stop shop token. Every token is different. It can be issued by a different entity, meaning it can be issued by a protocol, a decentralized protocol, or it could be issued by a company or an individual or a government even. You can have all types of different token types. You can have protocols that are inflationary and have to use proof of stake or proof of work in order to grow the network. Or you can see companies with fixed supplies like your Hyperliquids and your Binances that I mentioned that actually amortize their token through buybacks. So you're not going to have a simple answer to how do you value a token because every token is going to be built completely differently. But you will start to see some more homogeneous valuation techniques and frameworks that integrate things like the on-chain analysis and the ability to actually know exactly what's happening to a token on-chain, whether that being through reading a block explorer or via frequent updates from the company itself, but then also merged with your traditional financial valuations, right? One of the things I've said for a while now is that for anything to have value, it has to have some combination of financial, utility, and social value, right? Social value meaning just sort of brand and cool factor, very hard to measure. I don't think we'll ever come up with a way to measure that. But financial and utility value are easy, right? Financial value, you use traditional DCF frameworks and cash flow models to actually estimate what something is worth based on the revenue and cash flow of a model. That's obviously not going to work for a lot of protocols that have tokens, and certainly won't work for meme coins or things like Bitcoin. But it can work for your BNBs and your Hyperliquids and your Leos and your pumps, real companies that actually have real revenue and real profits that you can then find a value for the token. But we wouldn't stop right there. You then also look at the utility value, right? Is this token useful? Do you have to own it for any reason? Do you have to stake it? Do you have to pay gas with it? Do you have to use it for collateral? And that's where on-chain analytics can really merge with traditional frameworks to come up with sort of a homogeneous way that we value certain tokens. So I look forward to being a part of that. I think the Arca team will be on the cutting edge of coming up with a lot of these valuation techniques like we've always done, but also starting to see the rest of the market pay attention to this stuff as well. The third prediction is that I think companies are going to have to modify their communication strategies to potential investors in order to attract new capital. that target specific sectors and nuances with crypto, rather than just solely focusing on Bitcoin or crypto as a hedge or this sort of macro thing. So, I think this is both for fund managers like ourselves. The idea of a generic crypto fund is probably going away, and you're probably going to have more niche funds like a DeFi fund, or an RWA tokenization fund, or you might have just a layer one protocol fund, or you might just say, I'm only going to focus on companies with cash flows that we can actually model their tokens. Whatever the case may be, I think you're going to see a lot more niche strategies from fund managers. And similarly, I think from the exchanges and the other service providers that really act as the de facto investment banks. I'm talking about your Coinbases, your Binances, your even your brokers like your FalconXs and your Galaxies. They're no longer going to be able to just talk about crypto as a macro asset class, or cater to the smallest investment professionals out there, which is like your CTAs and your commodities guys. Like, eventually these guys are gonna have to grow up and learn that, like, if you want actually people to buy crypto and invest in this stuff, you have to differentiate. You have to talk about the different sectors and the different token types. You can't just, Coinbase, for example, sorry to pick on them, but they have one research analyst and the guy writes macro research. Like, why in the world, when there's 8,000 other macro newsletters out there, are you going to come to Coinbase for your macro research? You're not. You want to come to Coinbase to learn about tokens. So start writing about tokens, Coinbase. Change what you do. Same with everyone else. I think this is really the biggest differentiation. And I've talked about it before as well, is that you need more education in this industry. You need less misinformation. There's so many companies that just focus on Bitcoin, or just focus on macro, or just treat this industry like a student body left, student body right trade. And 2025 shows you the results of that. Is everything goes straight down because nobody understands what this stuff is. People can't differentiate between a stable coin and something like XRP and something like Bitcoin and something like a pump or a hyperliquid that has real cash flows versus something that's a straight meme coin. So, you want investors to come in the space. You want people to care about crypto. The big service providers and gatekeepers need to do a better job of educating. Prediction number 4. Basically, I think digital assets will start to absorb parts of traditional finance rather than replace them. And we're already seeing some of that, right? This was never which ecosystem are you going to be a part of? Are you going to be in this non-blockchain crypto world with, TradFi assets that trade on T+1, T+2 settlement? Or are you going to be on these crypto rails that are totally different assets and everything's 24/7 and instantaneous settlement? Really, the only way that any of this works is when you start to merge these together, which means that, again, eventually all assets are going to be on chain. You're going to have your stocks, your bonds, your real estate on chain. You're going to be able to trade your crypto and your stocks in the same place. It's no longer, I go to Coinbase to trade my tokens, and then I have to go to Robinhood to trade my stocks, and I got to go to TD to trade my bonds. Like, no, all this stuff is going to come together, and you're going to have basically one wallet or one interface where you're actually going to be able to trade and transact with all of your assets in one place. And ultimately, I think most of what we saw in 24 and 25 actually went the wrong way, right? That was bringing good on-chain technology and stuffing bad assets into antiquated T+1 rails, meaning, Bitcoin's a totally made-up asset that only exists because of blockchain. It's a good asset, but it's a made-up asset. Why are we moving Bitcoin onto ETF and stock rails via DATs and via ETFs when we know that those rails are antiquated? We need to go the other way, which is, let's take good assets like your Teslas and your Apple stocks, and let's move them to the better technology, which is blockchain. So I always said that the ETFs and especially the DATs were going to be, one step forward, 2 steps back. And I think 25 is a result of that, or rather you can see the result of that. In 2025. Now we have to start going the other way, right? Let's stop taking worthless, pointless crypto assets and putting them on slow, antiquated equity and bond rails. And let's go take the good assets, the bonds, equity, and real estate, and let's put that on better technological rails, which is blockchain. So, you're already seeing 300 billion of stable coins, which is just US dollar debt on chain. You're going to start seeing a lot more stocks, bonds, real estate, and other things on chain in 25 as well. And that's when you really know blockchain will be impactful. And lastly, prediction number 5, I really think that centralized finance is probably going to take even more of a backseat to DeFi. We've been pointing out the shout out to the Block and their great dashboards, but if you look at the amount of activity happening on DeFi rails versus centralized rails, it just keeps going up and to the right, right? Well, DeFi made up like 1% of total activity 5 years ago. Now it's up to 25% across DeFi derivatives exchanges and DeFi spot trading exchanges, as well as lend borrow platforms. That's just going to continue to grow because there's just no barriers to entry to the liquidity on these exchanges and on these DeFi exchanges and on these DeFi rails. You're just going to see more and more activity happening through DeFi, which increases liquidity, decreases slippage and trading costs, and ultimately just becomes, instead of this fragmented industry where everybody has their own market makers and their own trading platforms, you're going to see all of this liquidity, all of this trading activity concentrated in these DeFi applications and protocols. And ultimately, the centralized exchanges and service providers just become basically UI interfaces, right? You're going to go to Coinbase.com maybe because it's part of your workflow and because you're familiar with it, but you're not going to be accessing Coinbase liquidity or market makers on Coinbase. Coinbase is just going to be the front end UI, and you're going to be accessing some back end DeFi protocol. Same with when you go to a Robinhood. Same with when you go to a Binance. Ultimately, you're really going to rely on the workflows and the standardized workflows that investors are used to going to these websites, but they're all going to plug in through the back end to these DeFi protocols for the liquidity and the actual trading. So those are my big predictions for 2026. We'll see how they play out over the course of the year. In the meantime, please reach out to us on our website, ar.ca, or you can find me on Twitter X at jdorman81. And we'll be back throughout the year every week talking about the markets, talking about what's working, what's not working, and where we're seeing growth and interest in the blockchain and crypto space. So happy New Year, everyone. Good luck in 2026, and we'll talk soon. Thanks, everybody.